Hello and welcome to the day ahead. It is Tuesday, April 5th. I'm Andrew Gagan. Well, another bumper session on Wall Street overnight as tech and mega cap growth shares gave the three majors a boost. Twitter, the star performer, after Tesla chief executive Elon Musk revealed his 9.2% stake in the company. For reference, founder Jack Dorsey owns just 2%. Well, Twitter shares jumped nearly 30% on the news, while Tesla shares were up close to 6%, with record electric vehicle deliveries for the first quarter reported over the weekend, contributing to that momentum rally. Defensives and utilities were the biggest drag.
Looking at right now is the knock-on effects that are having to the markets right now. We've got the inflation knock-on effect. We've got higher commodity prices, huge drop in liquidity. That's something that average investors don't realize. But in the institutional space, not a lot of liquidity in oil, not a lot of liquidity in stock markets, and this is a bit of a problem. And it's keeping who I refer to as active investors, the bigger investors that really tend to support the market in a big way, sidelined. When are they going to come out? I'm really not sure. I think they're just staying in their bunkers right now until this war thing ends, and then they'll start to reflect on the markets again.
So investors remaining concerned about the Ukraine crisis, which has led to a spike in commodity prices that has worsened the outlook for already high inflation. In his closely watched letter to shareholders, JP Morgan chief executive Jamie Dimon warning of a possible $1 billion loss on its exposure to Russia. In other company news, Starbucks shares took a hit after its former chief executive, Howard Schultz, said the company would be suspending its stock repurchasing program. He's returning to the helm this week to lead the company for a third time. And US-listed shares of Chinese companies such as Alibaba were higher after China proposed revising confidentiality rules involving offshore listings. To fixed income, the benchmark 10-year Treasury yield ticked higher, though the 2 and 10 curve remains inverted. And to the bigger picture, the US dollar regained momentum on safe haven flows on the possibility of more sanctions against Russia as the war in Ukraine continues, with global outrage over civilian killings in the Bucha in the nation's north weighing on investor sentiment. Since its trough on February 24th when Russia invaded Ukraine, the greenback has gained around 3%. The market is expecting the EU to ramp up sanctions in response to allegations of war crimes, which would slow economic recovery further and put further pressure on the bloc's energy supply. Russia, though, has maintained gas flows through key pipeline routes into Europe, despite uncertainty over payment terms and those looming sanctions. Oil rallied overnight, the price of Brent crude up 3% to $107 a barrel. And French President Emmanuel Macron has indicated sanctions could be placed on oil and coal, while Germany's finance minister says all economic ties with Russia must be severed as soon as possible. Well, the euro took a hit overnight with the yen higher against its US counterpart. This as markets in mainland China remain closed for a second day, observing a public holiday. The Aussie dollar again going from strength to strength, well above 75 US cents. And in the cryptoverse, Bitcoin and Ether maintain a solid footing. This as the SEC previews the path forward for trading scrutiny and investor protection in the States when it comes to digital currency trading platforms. Okay, to the local market, and SPI futures are currently up 0.5%, indicating a solid opening this morning. Once again, commodities will be on the watch list, with the price of iron ore moving above $160 a tonne, and iron ore futures are up more than 1% as blast furnace rates in China lifted, which signals a lift in demand. Zinc rose to its highest price since 2006 as exchange inventories continued to decline, and gold continued its climb, up 0.5%. Well, quiet on the corporate calendar today, but focus firmly fixed on the RBA's interest rate decision handed down at 2:30 Eastern. No change from the central bank expected, but a hawkish tone in the statement is forecast, with the market's median forecast of the official cash rate to be between 0.75 and 1% by the end of the year. This comes hot off the heels of last week's cash splash federal budget and a looming election.
Petrol tax excise cut. Now, it's bad policy, but every country around the world seems to be doing something similar, and it will actually have a deflationary impact because it applies to petrol and diesel. feeds into our supply chain costs, so it will come down a little bit. So I don't think the Reserve Bank is going to sit there and really be bothered about what the budget's done. Need to be starting to raise, but I'm not that this needs to be June and we need to go hard and fast. And so maybe if they start in August, that to me leads you to that kind of number. Now, should we be a bit faster? Yes, but they've been consistent. People might not like it, but they've been consistent that wage growth is really what they want to see. And we're not seeing that in the sustained way yet that they talk about. Look, we might all be wrong, but I think that's where we're heading.
Yeah, I know.
And that is your day ahead. See you again tomorrow.